There's a financial term that sounds comforting, almost quaint: the sinking fund. It conjures images of responsible savers methodically setting aside money, building security for the future. Financial advisors love it. Personal finance gurus preach it. Save consistently, they say. Let compound interest work its magic, and watch your nest egg grow safely in your bank account. But here's what they don't tell you. That money sitting in your bank account, that sinking fund you've been diligently building, isn't actually yours anymore. Not in the way you think. And in the next financial crisis, it could vanish overnight, seized legally by the very institution you trusted to protect it. Not through robbery. Not through fraud. Through something far more insidious called a bail-in. Most people have never heard of a bail-in. Those who have usually confuse it with a bailout. But the difference between the two is everything. A bailout uses taxpayer money to rescue failing banks. A bail-in uses your money, your deposits, your savings. The cash you thought was safe because it was insured, protected, guaranteed. And it's not some dystopian theory, it's already happened. In 2013, the people of Cyprus woke up one morning to discover that their government had seized a portion of their bank deposits to prevent the banking system from collapsing. Not a tax. Not a fee. A direct confiscation of funds from people's accounts to recapitalize insolvent banks. The world watched. Some called it unprecedented. Others called it a warning shot. But what almost nobody realized at the time was that Cyprus wasn't an experiment. It was a template. The playbook. And since 2013, dozens of countries, including the United States, have quietly written bail-in provisions into law, establishing the legal framework to do exactly what Cyprus did. When the next banking crisis hits, and the question is not if, but when, your deposits could be on the table, not as a last resort. As a first option, this is the story of how we got here. How the rules changed without you noticing. How your bank accounts became collateral in a system designed to protect itself at your expense. And most importantly, how to structure your assets so that when the next crisis comes, you're not left holding an empty bag while regulators assure you it was all perfectly legal. March 16, 2013, a Saturday morning in Nicosia, Cyprus. Cafes along Ledger Street were filling with the usual weekend crowd. Families planning beach trips. Retirees reading newspapers over coffee. Everything normal. Everything routine until the news broke. The government, working through the night with European Union officials, had agreed to a bailout package with a catch. To receive 10 billion euros in emergency loans, Cyprus would impose a one-time levy on all bank deposits. Not just the wealthy, everyone. Accounts under 100,000 euros would be hit with a 6.75% charge. Accounts above that threshold would lose 9.9%. The reaction was immediate and visceral. People rushed to ATMs only to find withdrawal limits imposed. They tried to transfer money abroad. Blocked. The banks, anticipating panic, had already frozen accounts. For the next 2 weeks, Cyprus existed in a state of financial martial law. Capital controls restricted cash withdrawals to 300 euros per day. Businesses couldn't pay suppliers. Employers couldn't make payroll. The entire economy seized up like an engine without oil. On March 19, the Cypriot parliament, facing nationwide protests and genuine fear of social collapse, rejected the deposit levy. Politicians called it theft. Citizens called it worse. But the reprieve was temporary. The banks were still insolvent. The debt was still crushing. Cyprus was still out of options. By March 25, a revised deal emerged. This one was surgical. Accounts under 100,000 euros, covered by EU deposit insurance, would be protected. But the second largest bank, Laiki Bank, would be shut down entirely. Its insured deposits would transfer to the Bank of Cyprus. Everything above 100,000 euros would be converted into equity in a bank that might never recover its value. And then the real numbers came out. Depositors with large accounts at the Bank of Cyprus didn't just lose 9.9%. They lost nearly 48% of everything above the insured threshold. Converted to shares in a bank whose stock value had been obliterated. Thousands of businesses, retirees with lifetime savings, and foreign depositors, many of them Russian, saw half their wealth vanish in a legal restructuring designed to keep the financial system afloat. This wasn't a bank failure in the traditional sense. The government didn't nationalize the banks, didn't liquidate them, didn't use taxpayer funds to bail them out. Instead, they forced the bank's own creditors and depositors to absorb the losses. They called it burden sharing. Economists called it a bail-in. Depositors called it confiscation. The European Central Bank and the International Monetary Fund insisted it was the only viable path forward. The alternative, they warned, was a complete meltdown of the Cypriot financial system, exit from the euro, and economic devastation that would make the haircut look merciful by comparison. And so Cyprus became the first modern Western nation to implement a depositor bail-in, not during wartime, not during hyperinflation. During what was supposed to be a routine financial crisis managed by sophisticated international institutions with decades of experience. The precedent was set, and the world took notes. Before 2008, bank failures followed a predictable script. The institution would collapse, regulators would step in. The government would use taxpayer money to prevent contagion and restore confidence. Shareholders would be wiped out, bondholders might take losses, but depositors were sacrosanct. The system was built on trust, and trust required that people's money stayed safe. Then came 2008, the global financial crisis that nearly brought down the entire Western banking system. Lehman Brothers collapsed. AIG teetered on the edge. Major banks in the United States and Europe faced insolvency. Governments responded with bailouts totaling over $700 billion in the United States alone. Taxpayers footed the bill, and the public was furious. The outrage was bipartisan and visceral. Banks that had gambled recklessly with mortgage-backed securities and derivatives got rescued while ordinary people lost their homes and jobs. Politicians faced electoral consequences. Populist movements gained traction. The narrative of banks being too big to fail became toxic. So policymakers around the world made a decision. Never again would taxpayers be forced to rescue failing banks. There had to be another way. A mechanism that would keep systemically important banks afloat without requiring government funds. And they found one. The bail-in. The concept was elegantly simple from a regulatory perspective. Instead of external money coming in to save a bank, internal liabilities would be converted into equity. Bondholders would see their debt turned into shares. Large depositors, those above insurance thresholds, would have their cash converted into bank stock. The bank would recapitalize itself using its own creditors' money. No taxpayer funds required. The institution stays open, the financial system remains stable, problem solved. In 2010, the United States passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Buried in Title II, the Orderly Liquidation Authority was the legal framework for bail-ins. It granted regulators the power to seize control of failing financial institutions and impose losses on creditors. The language was technical. The implications were revolutionary. Banks could now, under certain conditions, use depositor funds to save themselves, not through theft. Through legal restructuring authorized by federal law. The FDIC illusion. Here's what most Americans believe about their bank deposits. They're insured, protected, safe. The Federal Deposit Insurance Corporation guarantees up to $250,000 per depositor, per bank, per ownership category. That's been true since 2008, when the limit was raised from $100,000 during the financial crisis. It's the bedrock promise of the modern banking system. When you see that FDIC sticker on the bank window, you know your money is protected. Except it's not that simple. And in the context of bail-ins, that $250,000 limit creates a massive vulnerability that very few people understand. First, the numbers. As of 2025, the FDIC's Deposit Insurance Fund holds approximately $125 billion. That sounds like a lot until you realize it's meant to insure over $10 trillion in deposits across the United States banking system. For every $100 in insured deposits, the FDIC has about $1.25 in actual reserves. The fund isn't designed to handle multiple major bank failures simultaneously. It's designed for orderly, isolated events. During the 2023 failures of Silicon Valley Bank and Signature Bank, regulators invoked a systemic risk exception. All depositors, including those with balances far exceeding $250,000, were made whole. The FDIC didn't use its insurance fund. Instead, it created special mechanisms to protect uninsured deposits because the alternative was contagion. But that exception was discretionary, not guaranteed, not enshrined in law. Next time, regulators might make a different choice. And here's where bail-ins enter the picture. That $250,000 insurance limit creates two classes of depositors: those below the threshold and those above it. For accounts under $250,000, FDIC insurance theoretically provides protection. But accounts above that limit, and there are trillions of dollars in such accounts, held mostly by businesses, wealthy individuals, and institutions, are fair game for bail-ins. These uninsured deposits aren't just vulnerable. They're explicitly designated as loss-absorbing capital under resolution frameworks. But even the insured deposits aren't as safe as people think. The FDIC's mandate is to protect depositors in the event of a bank failure. But a bail-in isn't technically a failure. It's a resolution, a restructuring. The bank doesn't close, it recapitalizes. And if regulators determine that a bail-in is necessary to maintain financial stability, that $250,000 insurance might not apply the way depositors expect. The language in Dodd-Frank and international resolution frameworks allows for significant discretion. Then there's the ownership category complexity. That $250,000 limit applies per depositor, per bank, per ownership category. A single person with an individual account gets $250,000 of coverage. But the same person with a joint account gets separate coverage. A revocable trust account provides coverage for each named beneficiary, up to 5, which could mean over $1 million in protection through careful structuring. Most people don't understand these distinctions. They think they have $250,000 of protection total. In reality, it's far more complicated, and without strategic planning, even people with modest savings can find themselves partially uninsured. Consider a small business owner with $500,000 in their business checking account. That's not unusual. Payroll for 20 employees, operating expenses, vendor payments. Half of that balance sits outside FDIC protection. If their bank enters resolution and regulators impose a bail-in, that uninsured $250,000 could be converted to equity, effectively frozen, potentially lost if the bank's restructuring fails. The business can't make payroll, can't pay rent, can't order inventory. The entire operation grinds to a halt, not because of bad management, but because of a legal mechanism that uses their deposits to save their bank. This is the sinking fund lie. The belief that money in a bank account is safe simply because it's in a bank. The assumption that insurance equals protection. The trust that regulators will always prioritize depositors over systemic stability. That trust is misplaced. Not because regulators are malicious, but because the system is designed with different priorities. The unrealized losses nobody talks about. Here's a number that should terrify anyone with significant money in the banking system. As of 2025, American banks are sitting on approximately $500 billion in unrealized losses. These aren't bad loans or failed investments that have already crystallized. These are losses on assets, primarily government bonds and mortgage-backed securities that are currently on the books at values higher than what they could be sold for today. And the reason is simple: interest rates. When rates were near zero, banks loaded up on long-term bonds paying low rates. Standard procedure: safe investments. But then inflation surged and the Federal Reserve raised rates aggressively. Those older bonds, paying 1 or 2%, became worth far less in a market where new bonds pay 4 or 5%. The math is straightforward. If you're holding a bond that pays 2% and new bonds pay 5%, your bond is worth significantly less. Banks do have to recognize these losses immediately because they hold these securities in portfolios marked as held to maturity. The accounting rules allow them to carry the bonds at face value as long as they don't plan to sell. But that's an accounting fiction. The losses are real. And if a bank faces a liquidity crisis and needs to sell assets quickly, those unrealized losses become very realized very fast. Silicon Valley Bank learned this lesson in March 2023. The bank had invested heavily in long-duration securities during the low-rate environment. When depositors, mostly tech startups facing a funding drought, began withdrawing money rapidly, SVB had to sell bonds to meet redemptions. Those sales triggered massive losses. The bank's capital evaporated. Regulators seized control within 48 hours. It was the second largest bank failure in American history. And it wasn't caused by reckless lending or fraud. It was caused by an asset-liability mismatch that exists, to varying degrees, across the banking system. The $500 billion in unrealized losses means that dozens of banks are technically underwater. Their liabilities exceed their assets at market value. They remain solvent only because accounting rules allow them to pretend otherwise. This isn't a secret. Bank regulators know. The banks know. But as long as depositors don't panic and force mass withdrawals, the system stays stable. This is fractional reserve banking at its most fragile. The entire edifice depends on confidence. And when confidence breaks, things move fast. In 2025, 63 banks are on the FDIC's problem bank list. These are institutions that regulators have identified as having significant weaknesses that could lead to failure. The names aren't public to avoid triggering runs. But the number is higher than it's just been since the aftermath of 2008. 2 banks have already failed this year. Pulaski Savings Bank in January. Santa Ana National Bank in June. Both were smaller institutions. Both were resolved through traditional methods, but the trend is worrying. And the unrealized losses are a ticking time bomb that grows more dangerous with every economic shock. This is the environment in which bail-ins become not just possible but probable. Regulators are not going to let systemically important banks fail. The 2008 experience taught them that contagion in the financial system can cripple the entire economy. But they're also not going to ask taxpayers to fund bailouts. The political costs are too high, so they'll use the tools they've given themselves. And those tools include converting depositor funds into bank equity, building fortress finance, the multi-bank strategy. The first line of defense against a potential bail-in is understanding that no single bank should hold all your assets. This sounds obvious, but most people never think about it. They have their checking account, savings account, maybe a certificate of deposit, all at the same institution. Convenient, easy to manage, and extraordinarily risky. The FDIC insurance limit of $250,000 per depositor, per bank, means that spreading funds across multiple FDIC-insured institutions effectively multiplies your coverage. If you have $500,000 in cash, keeping it all in one bank leaves half uninsured. Split across 2 banks, you have full coverage. Split across 3, you have room to grow. This isn't complicated financial engineering. It's basic risk management that most people never implement because it seems like overkill until the moment it isn't. But it's not just about insurance. It's about diversification of risk. Banks have different business models, different concentrations of assets, different exposures to regional economies or specific industries. A bank heavily involved in commercial real estate might be vulnerable if property values crash. A bank focused on agricultural lending faces risks if commodity prices collapse. By spreading deposits across institutions with different profiles, you reduce the likelihood that all your banks face problems simultaneously. One might stumble while the others remain solid. The ownership category rules add another layer of protection. An individual account, a joint account with a spouse, and a revocable trust account with named beneficiaries are all separate categories for FDIC insurance purposes. A married couple can structure their accounts to protect well over $1 million at a single bank through careful use of these categories. Individual accounts for each spouse at $250,000. Joint account at $500,000 total, $250,000 per person. Revocable trust accounts with multiple beneficiaries, adding hundreds of thousands more. The FDIC provides an online tool called ED, the Electronic Deposit Insurance Estimator, that calculates exactly how much coverage you have based on your specific account structure. But here's the critical point. This strategy protects against bank failure. It doesn't fully protect against bail-ins. Because bail-in provisions in resolution frameworks can override standard insurance in certain scenarios. If regulators determine that imposing losses on deposits is necessary to prevent systemic collapse, the $250,000 guarantee might not function as expected. The language is vague deliberately. It gives regulators flexibility, which means depositors need strategies that go beyond simply staying under insurance limits. This is where the choice of banks matters. Not all banks are equally likely to face bail-in scenarios. The concept of systemically important banks, institutions deemed too big to fail because their collapse would endanger the entire financial system, creates a paradox. These are the banks most likely to be subject to bail-in provisions because regulators will do whatever it takes to keep them operating. But they're also typically the most stable, well-capitalized institutions. Smaller regional banks might be safer from bail-ins because they're not systemically important. But they might also be more vulnerable to outright failure. There's no perfect answer. The optimal strategy likely involves a mix. Some funds in large, systemically important banks that are unlikely to fail but might impose bail-ins. Some funds in smaller, well-managed regional institutions that pose lower systemic risk. And critically, some funds outside the banking system entirely, in assets that cannot be seized or converted through resolution mechanisms. The Treasury alternative. Government bonds as a safe haven. If banks are vulnerable to bail-ins, where does money go to be truly safe? One answer, perhaps the most straightforward, is United States Treasury securities. These are direct obligations of the federal government, not mediated through banks, not subject to bail-in provisions, backed by the full faith and credit of the United States government, which, despite its fiscal challenges, remains the most creditworthy borrower in the world. Treasury bills, or T-bills, are short-term government securities with maturities ranging from a few days to 1 year. They're sold at a discount to face value and redeemed at par when they mature. The difference between the purchase price and the face value is the interest earned. Unlike a savings account, where interest accrues and rates can change, T-bills provide a fixed return known at purchase. You buy a $10,000 T-bill at $9,800. In 26 weeks, you redeem it for $10,000. That $200 difference is your return locked in, guaranteed. The yields on T-bills closely track the Federal Reserve's interest rates, often providing returns competitive with or better than high-yield savings accounts. As of late 2025, short-term T-bills are yielding around 4 to 5%. That is comparable to the best savings account rates and significantly higher than the average bank savings account paying less than 0.5%. But the real advantage isn't yield. It's safety and structure. T-bills carry no credit risk. The United States government has never defaulted on its debt. While future scenarios are debatable, the reality is that treasuries are considered the safest asset in the global financial system. More importantly for this discussion, T-bills cannot be bail-in-ed. They're not bank deposits. They're government securities. If you hold them directly through Treasury Direct, the government's online platform, there's no intermediary that can impose losses or convert them into equity. The tax treatment of T-bills provides an additional advantage. The interest earned is exempt from state and local taxes. For residents of high-tax states like California, New York, or New Jersey, this can represent a significant after-tax benefit compared to bank interest, which is fully taxable. A T-bill yielding 4.5% in a state with a 10% tax rate effectively yields more than a bank account paying 5% after taxes are considered. Liquidity is another consideration. T-bills can be sold before maturity on the secondary market. There's no early withdrawal penalty like with certificates of deposit. The market for treasuries is the most liquid in the world, with trillions of dollars traded daily. If you need cash, you can sell. The price might fluctuate slightly based on interest rate movements, but for short-term bills, the price variation is minimal. You get your money back plus most of your expected interest even if you exit early. But T-bills aren't a complete solution. They'd be best suited for cash that you don't need immediate access to but want to keep safe for a defined period. Emergency funds. Money earmarked for a specific purchase in 6 months or a year. Funds you want to protect from bail-in risk while earning a reasonable return. They don't replace checking accounts for daily transactions. They don't provide the instant access of a savings account. They're a strategic allocation within a diversified financial structure. The process of buying T-bills is straightforward. Treasury Direct allows individuals to purchase directly without fees or commissions. Most brokerage accounts also offer access to treasuries, sometimes with easier interfaces and integration with other investments. The minimum purchase is small, typically $100, making them accessible even for modest savers. And unlike savings bonds, which have holding period restrictions, T-bills are freely tradable from day one. For those concerned about banking system instability, allocating a portion of cash reserves to T-bills creates a firewall. This isn't money in a bank that can be seized or converted. It's a direct claim on the government. If banks face a crisis and bail-ins are implemented, your T-bills are untouched. When they mature, the funds go directly to your account. You've removed that capital from the banking system's reach while maintaining safety and earning a return. It's not a perfect solution, but it's a powerful tool. When paper becomes promises, the case for physical assets, there's an uncomfortable truth at the heart of the modern financial system. Almost everything you own is just data on a server somewhere. your bank balance, your investment portfolio, your retirement accounts. All of it exists as electronic entries that can be changed, frozen, or restructured with a few keystrokes. When you own physical assets, that calculation changes entirely. Gold and silver have served as stores of value for thousands of years across every civilization. They're not relics. They're the ultimate non-confiscatable assets. When you hold physical gold or silver, you possess something with intrinsic value that doesn't depend on any institution's promise. Banks can fail, currencies can collapse, governments can impose capital controls. But an ounce of gold remains an ounce of gold. No counterparty risk, no bail-in vulnerability, no electronic ledger that can be edited. The role of precious metals in a bail-in protection strategy isn't about speculation or getting rich. It's about insurance. A portion of assets held in physical form that cannot be seized through legal restructuring of financial institutions. When Cyprus imposed its bail-in, people with cash in banks lost access to their funds. People with gold in a safe at home did not. The difference is fundamental. Gold is the traditional choice. It's globally recognized, easily valued, highly liquid. Major dealers and banks around the world buy and sell gold daily at transparent prices. An ounce of gold is an ounce of gold whether you in New York or Tokyo or London. That universal acceptance makes it the most straightforward precious metal for wealth preservation. During the financial crisis of 2008, gold prices surged as investors sought safety. During the COVID pandemic, gold hit all-time highs. The pattern repeats. When confidence in the financial system wavers, capital flows to gold. Silver offers different characteristics. It's more affordable per ounce, making it accessible for smaller investors. It has significant industrial demand, particularly in solar panels and electronics, which provides a fundamental value floor beyond its monetary role. But silver is more volatile than gold, with larger price swings in both directions. It's less liquid in very large quantities, and it's bulkier to store. $1 million in gold is a briefcase. $1 million in silver is a pallet. For most people, silver makes sense as a complement to gold, not a replacement. Platinum and palladium are more niche. They're heavily tied to industrial uses, particularly automotive catalytic converters. Their prices can be influenced by factors unrelated to financial stability. They're less liquid than gold. But for investors looking to diversify within precious metals, they offer exposure to different market dynamics. A portfolio might include 70% gold, 20% silver, and 10% in platinum or palladium for additional diversity. The key decision is physical versus paper. Gold and silver can be owned through exchange-traded funds, mutual funds, mining stocks, or futures contracts. These paper instruments offer convenience and liquidity. But they don't offer protection against systemic financial failure. An ETF is a security. If the financial system experiences a severe crisis, securities markets can freeze. Broker-dealers can fail. Counterparty risk, the risk that the other party in a transaction won't fulfill their obligations, becomes acute. Physical metal eliminates that risk entirely. Storage is the practical challenge. Home storage is an option for smaller quantities. A safe bolted to the floor in a secure location. The advantage is immediate access. The disadvantage is theft risk and insurance considerations. For larger holdings, professional vault storage through specialized firms offers security, insurance, and often the ability to take physical delivery if needed. Some investors split their holdings, keeping some at home for emergency access and some in professional storage for bulk holdings. The allocation to precious metals in a bail-in protection strategy is a matter of debate. Conservative financial advisors often suggest 5 to 10% of total assets. More aggressive strategies, particularly those anticipating significant financial instability, might allocate 15 to 20%. The right answer depends on individual risk tolerance and financial situation, but the principle is clear. Assets held in physical form cannot be bail-in-ed. They're outside the system. And in a crisis scenario, that could make all the difference. Layered defense. Putting it all together. No single strategy provides complete protection. Banks offer convenience but carry bail-in risk. Treasuries provide safety but limited liquidity. Precious metals offer security but no income. The solution is layered defense. Multiple strategies working together to create a robust financial structure that can withstand various crisis scenarios. Think of it as concentric circles of protection. The innermost circle is immediate liquidity. Checking accounts with enough to cover a month or two of expenses. High-yield savings with 3 to 6 months of emergency funds. This money needs to be accessible immediately. Split across at least 2 banks to ensure FDIC coverage and reduce risk of losing access if one institution faces problems. This is your operational layer. The next circle is short-term preservation, Treasury bills with staggered maturities. Some maturing in 3 months, some in 6 months, some in a year. This creates a ladder where cash becomes available at regular intervals, providing flexibility while keeping funds safe from bail-in risk. This layer earns better returns than savings accounts and provides a buffer you can tap into for larger expenses or emergencies. Beyond that is the diversification layer. Funds spread across multiple banks using different ownership categories to maximize FDIC insurance. Perhaps some in regional banks known for conservative lending. Some in larger institutions with strong capital ratios. The goal is to have no more than the insured limit at any single institution while maintaining enough aggregate liquidity to handle significant expenses. Then comes the alternative assets layer. Physical precious metals stored securely, representing perhaps 5 to 15% of total assets. This isn't money you expect to spend. It's insurance against systemic breakdown. In a scenario where banks freeze accounts and financial markets seize up, precious metals remain accessible and valuable. They're the ultimate fallback. Each layer serves a purpose. The checking and savings accounts handle day-to-day life. The Treasury bill ladder provides liquidity and yield without bank risk. The multi-bank structure ensures FDIC coverage and reduces concentration risk. The precious metals offer protection against the catastrophic scenarios that keep people awake at night. Together, they create a system where no single point of failure can devastate your financial life. Rebalancing matters. Over time, as T-bills mature and savings accounts grow, the allocation shifts. Periodically reviewing the structure and moving funds to maintain the desired balance ensures the strategy stays effective. This isn't set it and forget it. It's active management, though not on a daily or even weekly basis. Quarterly reviews are usually sufficient for most people. The mindset shift required is significant. Most people want simplicity. One bank, one app, everything in one place. Convenient. But convenience and security are often inversely related. The structure described here is more complex. Multiple accounts, different institutions, physical assets to manage. It requires organization and record keeping. But the trade-off is resilience. When the next financial crisis hits, and history suggests it's a question of when, not if, this structure provides options, multiple escape routes, diversified risks, the ability to access funds even if part of the system is frozen. The uncomfortable questions nobody asks. Here's the part of the conversation that makes people uncomfortable. If this is all legal, if governments have granted themselves the power to seize deposits during banking crises, why should anyone keep significant money in banks at all? And if enough people reach that conclusion, doesn't that create the very bank-run scenario the system is trying to prevent? These are legitimate questions, and they get to the heart of the tension in modern banking. The entire fractional reserve system depends on trust. Banks don't keep your deposits sitting in a vault. They lend them out. That's how they make money. Your deposit is simultaneously your asset and the bank's liability, but it's also the loan to someone else. The system works only as long as not everyone asks for their money back at the same time. Bail-in provisions were created to prevent taxpayer bailouts. But by making clear that depositor funds can be seized, they might have eroded the very trust that keeps people from withdrawing their money en masse. The counterargument is that FDIC insurance addresses this concern for most people. If your balance is under $250,000, you're protected even in a bail-in. But that protection is only as good as the FDIC's resources. And as discussed earlier, the FDIC doesn't have enough money to cover multiple major bank failures simultaneously. During the Silicon Valley Bank crisis in 2023, the government invoked emergency measures to protect all deposits, not just insured ones, but that was a discretionary decision. There's no legal requirement to do so. Next time, regulators might make a different choice. There's also the international dimension. Cyprus demonstrated that depositors can be sacrificed. Denmark implemented bail-ins in 2011 without major fallout. The precedents exist. The legal frameworks are in place. And while no G7 country has yet imposed a depositor bail-in on a systemically important bank, the absence of precedent is not the same as impossibility. The tools are there. The question is under what circumstances they'll be used. The optimistic view is that regulators learned from Cyprus and 2008. They understand that maintaining public confidence is paramount. They'll use bail-in powers only as a last resort and will protect smaller depositors even at the cost of creating moral hazard. The pessimistic view is that in a true crisis, when systemic stability is at risk, regulators will use whatever powers they have. And depositors, particularly those with large balances, are now officially part of the loss-absorbing capital structure. The practical reality is that most people will continue using banks because there is no realistic alternative for daily financial life. You can't pay rent with gold bars. Employers pay via direct deposit. Bills require electronic transfers. The banking system is embedded in the infrastructure of modern existence. The question isn't whether to use banks at all. It's how to structure your relationship with them to minimize vulnerability. This comes down to the sinking fund fallacy. The idea that accumulating money in a single bank account is inherently safe because banks are regulated and insured. That was true once. It's less true now. The regulatory framework has changed. The priorities have shifted, and depositors need to adapt. The strategies outlined here, multiple banks, Treasury securities, physical precious metals, aren't paranoid overreaction. They're prudent risk management in a system that has explicitly made depositors part of the loss absorption mechanism. Cyprus wasn't a one-off event, it was a proof of concept. The legal frameworks exist in dozens of countries. The precedent is set. And when the next crisis comes, those who structured their assets defensively will have options that others won't. If this has changed how you think about where you keep your money, hit that like button and subscribe to Market Memories. Because understanding financial history isn't just about knowing what happened. It's about recognizing the patterns before they repeat. The next banking crisis might be years away. Or it might be months. But when it comes, the time to prepare will have already passed. Structure your defenses now while everything seems stable. Because that's exactly when nobody thinks they need to.